Welcome to the Multifamily Investing Show, your source for market forecasting, investment, and operational strategies. Your host is Michael Becker, a principal at SPI Advisory and a Dallas-based multifamily operator who has purchased over 10,000 apartment units and manages over $1 billion in assets. Join us as Michael interviews the top players in the world of multifamily brokerage, investment, financing, and economics. And here is Michael Becker.
Welcome to the Multifamily Investing Show with Michael Becker. I'm Michael Becker. Today, excited to have my friend Ken McElroy on. Ken is the principal of NC Companies based out of Phoenix, Arizona. Ken, how are you doing today?
Good. How you doing, Michael? Great seeing you.
Yeah. Ken's coming live from Scottsdale, Arizona, and you might notice we're in a little bit different studio than normal. We had some technical issues right before we're supposed to start recording, so we had to call an audible, but very excited to have Ken on. Ken, maybe talk a little bit about your background. You guys, you're a principal in MC Companies. You've been in business a really long time. You guys own properties in multiple states. Maybe give a little brief background on yourself.
Happy,
MC Companies.
I'll do the quick version. So I started in Seattle in multifamily, actually while I was at school, university. So I ended up managing a property while I was trying to finish it. I was trying to avoid student loans. I got free rent and a little bit of salary, and that immersed me into multifamily and the property management world. And then I went to work for a company up there in Seattle. It's now called Pinnacle. And at the time it was John Goodman, Goodman Management, and worked for him for a long time. And then I partnered my first venture in my late 30s, mid to late 30s, was with one of the guys that worked there. And we found that was when I first started doing multifamily on my own, and that would have been in the mid 90s. And then after that, we sold off, and I started my new firm, which I have with my partner, Ross McAllister, which is MC Companies. And so we have right around 7,000 units right now. We sold off, as you know, Michael, a couple thousand about a year ago. And so we're primarily focused on ground up construction, but we've got around 250 employees. We do our own construction. We do our own development. We have thousands of real estate investors that invest with us and syndicate. So when we put a deal together, we go to that bucket. And so we're not working with any institutional groups. We're just doing high net worth. And we've had a really nice little run. We have our own management company, and we're just looking for opportunistic deals with our investors at the moment, and trying to buy in this crazy market that we're in right now.
So let me ask you a question. Are you interested in investing in high-quality multifamily properties with a proven and experienced operator? Michael Becker and his team at SPI Advisory have successfully purchased, repositioned, and sold thousands of apartment units with substantial profits over the years. If you would like to get notified when investment opportunities open up, please go to www.multifamilyinvestingshow.com and fill out the contact form. You will be notified when SPI Advisory has a new investment opportunity.
Ken, you're really one of the rare people that have kind of been able to cross many different disciplines within the multifamily space. You did basically where you started really was kind of the value add, your C class, your B class multifamily. You've now transitioned to a lot of ground up development. You also are on kind of primary markets as well as secondary markets, and you're in 3 or 4 different states as well right now?
Yeah, we are. Yep, that's a good point. So, I've actually done, we've done some ground up construction. So the thing about multifamily is it's kind of a timing thing. And so right now you can pay for, in a lot of markets, you can pay very expensive numbers for, let's say, Class B assets, and we can actually build them for at or less. So I can actually build in many markets at the same price that people are paying for the Bs. And so that's why, Michael, at sometimes we're looking at those, say, value add Bs. And, but that's usually when there's not a lot of rent growth. And so what happened is early in the cycle, a Class B doesn't really have value add. And then kind of later in the cycle, it has value added. So if you still own it, obviously you can kind of buy it for, call it 50 cents on the dollar, 60 cents on the dollar, which we were doing from the banks, and value add, which is what we did to a big part of our portfolio. And then I've done condominium conversions too. So I bought apartment projects. We did several thousand units of those and sold them off individually. And so everything I've done has been kind of dancing around multifamily. But right now, we're primarily working on new construction because I still think that there's a big demand for multifamily long term.
And so what markets are you really focused on? Because you haven't really been, you own a couple assets in Dallas, which is where I'm based. So I'm familiar with you from that. But where are you kind of focused on your development right now?
Well, we're based in Scottsdale, which is why we're obviously in Tucson, Scottsdale, Flagstaff. Those markets are 2 hours either direction, south or north. So and of course, the general Phoenix area, and there's a lot to do here. But then from there, we're really in most of the cities in Texas, and we're looking at, we've been in Portland, we've been in Las Vegas, we've been in Seattle, and we're obviously starting to look at those markets, and, we're starting to look at anything. These migration patterns are very interesting, watching where people are going, with the remote work and telework and also affordability and weather and all that kind of stuff. So things are changing right now, and we're kind of stepping back and saying, okay, where are people heading? Where are they going? And that's where we want to be. We want to be in that next market.
And it seems to me, correct me if I'm wrong, but you're focused a little bit more on Tucson, which is kind of more of a secondary market than really Phoenix nowadays. Obviously, you own a bunch of assets and operate them still, but the newer deals you're doing tend to be a little bit more secondary markets. Why is that? What's driving you there?
Well, a couple of reasons. One, we know Tucson well. So we have an office there. We own maybe 2,000 to 3,000 units there. So, we understand the dynamics, we understand the occupancy, the operating expenses, and, kind of where rent growth is, and the submarkets, as you know, which are really, really important. So Tucson, while it's definitely a tertiary market as compared to Phoenix, it doesn't have the demand that Phoenix has. So in Phoenix, we're still bumping around with, everybody else. But in Phoenix, when we make an offer on a deal, we could have, 20, 30 offers, whereas in Tucson, we might have 8 to 10. And so there's less competition on the buy side. But we see, when you look at Phoenix and Tucson, you see the fundamentals are not all that much different. So we really like Tucson. Obviously, we're there. We have a bunch of properties, and we're doing new construction there. We're also doing construction in the greater Phoenix area. So, we like both markets. Tucson or Phoenix is definitely, obviously, more diverse, has more employment, more stuff to do than Tucson. So you can get burned in a small tertiary market for sure. So you have to know what you're doing and buy in the right area.
Yeah. So one of the things that you kind of have a perspective on that I don't, and a lot of people that watch our show, we tend to focus so much on Texas. That's where I'm based and what I own. But you also own in Arizona as well as Texas. So I don't know if you have any sort of thoughts or what's your perspective of kind of the differences between the two different markets? Because I know they're both growing. Demographics are, following the jobs, and population is growing. Any thoughts around that?
Yeah, for sure. I mean, when we first went to Texas, we basically looked at Dallas as the kind of the epicenter. Obviously we're in Houston, San Antonio, and Austin, and all the other markets too. But specifically, the Dallas area is where we started. And we kind of saw, if you took a look at the growth, the population growth, the employment growth, it was kind of going all north, kind of up in this, pie section. So Carrollton, Richardson, Frisco, Plano, and it's proved to be that now. Obviously, look, this was going back probably 10, 12 years ago, maybe even more. So before we first started going in, and so we wanted to be in the path of progress. There's nothing wrong with South Dallas, but at the time, that wasn't an area that a lot of people were moving to, and since now they've moved there because of affordability. But so we kind of do that in every single market. So whether we were in Fort Worth or San Antonio or Austin or even Houston, we were trying to be in the path of progress. And as you know, no matter where you are, you want to be in the path of progress. Doesn't really matter what kind of real estate you're getting. You want to be obviously where people are heading, because real estate exists for people. And so, you could buy real estate on the fringe, but if nobody rents it, then your occupancy is low, and, all the myriad of things that can happen around, not being in kind of the epicenter. So it's a fine balance of, being in the middle of everything and paying the right price. So at the time, downtown Dallas was expensive, and a lot of people weren't living there. And we're kind of I like the kind of middle of the road stuff. At the time, the $1,000 rent stuff, it's not $1,000 anymore, but as opposed to $2,000 or $2,500 or $3,000 down in Dallas. I remember going to a steakhouse down there near the stadiums, and it was like you could shoot a gun through there. There's nobody in there. Like, it apparently is only, packed after a game. And so, the downtown areas, even in Phoenix, can be very different in the evenings, depending on the sports teams or whatever. But generally, at least at the time, there wasn't a lot of people in those areas, and things were kind of moving out into the suburbs. So we wanted to be out in that area. And so we still own properties, as you know, out in those areas, and they've done very, very well.
So what's maybe some of the differences between like Arizona? How does it function versus, say, Dallas? As I think of the main things just from an outsider looking at Arizona that you have as an advantage over Texas is you have lower insurance, and your taxes a lot more predictable than they are in Texas, where Texas they can accelerate a little bit more. Any thoughts around that?
Oh, that's for sure right. So as an example, insurance is significantly higher, especially in Houston, as the tornado states and the hurricane states along the Gulf. We had property in Baytown at one time, as you know, and so those are real things. Property taxes, even utilities, in many areas. And so obviously on the operational side, that's a big deal. For us, Texas is a exciting place because I think it has it's massive, but it has a lot of people that move there, and I still think it's pretty affordable, just like Phoenix.
Yep.
So Phoenix and Texas, generally in most areas, are pretty affordable when you start to look at some of the other metros, like Portland, Seattle, the LA, Southern California, even Salt Lake City has gotten pretty expensive. So you start to look at these things, and especially now, people are taking a look at school systems, and they're looking at rent, and they're looking at where, they can work remotely. Where's that going to be? And so all that stuff's considered. Dallas or Texas in general is a very exciting state. Obviously, Austin has its own tech thing going.
Yep.
Houston has its own oil and gas thing going. Dallas is super diverse with, financial and in the finance world and oil and gas and a number of other things. And San Antonio's kind of healthcare, I guess, and among other things. And so Arizona doesn't have that kind of diversity. I mean, Flagstaff is really small. Tucson's generally pretty small, and Phoenix has a little bit of that diversity. But there's a lot of good things going on in Texas, and so we really think Texas is a great place to be long term.
Yeah. So speaking of that, maybe we kind of transition another part of the conversation today. Talk maybe a little bit about kind of the state of the market as you see it as we're entering 2021 as we record this right now. What are your kind of general thoughts of the market? I mean, it was a pretty choppy year, I guess, for lack of a better term, that we just came out of 2020. Any kind of reflections back on 2020, and then kind of what are you looking forward to in 2021?
Well, it's interesting. It's a bit confusing because the government, I think the Fed, all the CARES Act and all the new stimulus has kind of propped things up. So, they've made, not paying your mortgage okay. They've made not paying your rent okay. And that affects lenders, it affects landlords, it affects banks and their earnings and all those kinds of things. So we have that. And then we have this COVID pandemic, and we have, I think, a lot of permanent change in where people are going to be, where they're going to work, where they're going to live. And so that's obviously a permanent change. But the biggest thing, I think, is going to be around unemployment. And that's, I still think, kind of propped up. I mean, the government threw some PPP money at that, and a lot of businesses needed that. But, that, I think in a lot of cases, that's just kicking the can down the road, even if they offer more, because, there's a lot of change around the ways the service industry, the travel industry, the hotel industry, all that stuff is going to be permanent for a long, long time. And I think there's going to be markets, like let's just pick on Las Vegas or Orlando, or Miami, where you've got some cruise stuff going on. So you can kind of see, obviously New York is in big trouble, and so you're going to see this kind of permanent change moving forward. So that's all super confusing, but I think people are trying to predict it, and that's fine, but it just takes so long to unwind all that stuff, Michael, as you know. I mean, if I'm losing a property, and I'm doing everything I can to from cash calls to spending money on reserves to try to get through this time period when tenants aren't potentially paying me, and I'm working with the banks and all those kinds of things. And so all that's happening kind of behind the scenes, and we don't know yet to the extent of all that. So I think you're going to see a very different market over the next 2 years, 2020, this year, 2021, we're already here. And next year, I think you're going to start to see that stuff slowly unravel. I always tell people, I think COVID was an accelerator. So it basically took, I have a lot of friends in hotels, I have a lot of friends in retail, and they're not doing that well. Unless there's like an anchored grocery store in a local plaza that's kind of pulling the weight for the rest of the real estate. But if you're in a standalone retail and you own it, and you have some of these small businesses that are trying to make it, I think those are potential issues down the road for acquisitions. You got to kind of wait for those to the lenders are going to do what they can within their power, and the people who own those are going to do what they can to hold on to those. But those are going to be ripe for redevelopment in the next 2 to 3 years, which is kind of why we're focusing on some of our new construction, because you're going to start to see, I think, some of these corners open up and some redevelopment plays. And we're certainly seeing it in the malls. The malls are in trouble, and the rents are very expensive there. And people aren't going there for multiple reasons. One, they can order from, on their phone in a second. And then the other is, COVID and all the health things around that. So there's a lot happening on single family and multifamily and residential, and industrial's on fire. So it's an exciting couple of years, and I think that I'd like to see it end. I'd like to see like everything get to to the end and not be propped up financially, and then start to rebuild, because that's when you really make money.
Yeah. So looking backwards before we go forward, did you guys really experience much operational disruption? I know we had some delinquency, and my portfolio went from historically having around 1% of scheduled rents being delinquent or uncollected, and we went to about 3.5–4%. And then here, kind of finishing off 2020, it's kind of went up to close to 5%, as I think some of the tenants prioritized buying Christmas gifts for the kids versus paying their rent. What did you guys experience in your portfolio?
Yeah, very similarly. We're plugged into the same folks with national housing, some of the national housing providers, and we're all communicating, which is great. And I think that depending on where your property is, we have property in Oklahoma too, and we had some problems in some of our Tulsa properties because they were working in the service industry, as an example. So heavy service industry, casino, that kind of stuff. So, that property specifically is not doing as well as, let's say, my property in Plano, Texas. And so it was very, very specific based on the demographic of the the people in the property, and also the location. So if you've got a property that was, located maybe not open or shut down temporarily or may not reopen, you're going to have that kind of stuff. Just similar, like, like when we see, this is a dramatic example, but when you see like a military base, close, and we've seen that over the years in our business, it hurts an area all over the place. Or in Detroit, when the auto dealers, close, so those have ripple effects. And so I think you're going to start to see that. I do in a lot of markets. And so it just depends on the property itself. But overall, we've been pretty good on the multifamily space. We went through this in 2008, a little different, but in 2008, people moved out of houses and into rentals. And I think that we might see that coming up. And I think that's going to bode really well for the multifamily market. So I think we're going to have a temporary rough time in 2021 if the eviction moratorium ever gets lifted. And then, I think you'll start to see the rubber will hit the road. The landlords and the management companies and the owners will take their hits. And then but I do think there's going to be another wave of rentals based on the fallout from single family, just like we saw in 2008.
So you say that, so operationally maybe a little bit choppy, but on the investment sales market, we were kind of talking previously, it seems like it's absolutely on fire. I mean, there's multiple offers on all these deals. Interest rates are extremely low. I mean, SOFR, which is a new LIBOR, is less than 10 basis points. 10-year treasuries, as we record this, I think is somewhere around 90 basis points. So it's really, a lot of debts available, still really robust and abundant in the multifamily space. So you're getting even higher leverage because these deals are actually underwriting a little bit better just because of the function of the interest rates being lower. So it's really kind of driving pricing up quite a bit. I know you sold a bunch of deals a year or two ago. Then I actually heard you on your podcast. I heard you talk about a deal you were bidding on in suburban Dallas and how crazy it was. I thought that was actually a pretty good illustration of kind of what's going on in the marketplace. So maybe talk about that a little bit.
Yeah, of course. Yeah. I mean, when you think about it, from an institutional money standpoint. So you got to start there. So let's say you own apartments in New York. Let's say you own a retail in New York or Seattle or California, or San Francisco, LA, whatever. It doesn't really matter. But let's say you're me or you, and we're sitting on a bunch of stuff in Portland. And Portland just passed a rent control law and all these other laws to protect the tenants, which is fine. I don't even want to go down that road here. But the point is, as an ownership, you're looking at all these things. You're looking at government policy. You're looking at property tax. You're looking at the way they handle everything. And so a lot of those properties, as you know, Michael, got put into got listed and got sold. And so you have those people coming out of those markets, and they're like California specifically. You've got these 1031 buyers. And so if you've cashed out on something that you own in San Diego, let's say, and Phoenix is one of your locations, then you are going to overpay because obviously you're trying to avoid tax. And so right now we see a lot of 1031 buyers. In addition to that, we have a lot of people that have created funds, and they have a lot of money raised in various vehicles. And so there's pressure on them to put that money to work. And so you have that. So you have, guys paying, all cash, no debt, $1 million down hard day one. You got 1031 buyers that are paying 2, 3, 4, 5 million more than we're willing to buy. We have acquisition guys, as you know, like yourself, and we're flying around, we're looking at deals, we get the same numbers as everyone. So you got 20 people at a table, they're all looking at the same stuff. I mean, we sign an NDA, we get the financials, we get the broker package, and we get all that stuff, and we evaluate, we underwrite it. And the truth is, we all come pretty darn close to the same NOI. The question is how much further do you want to push the price? And then that affects your return. And so for a guy like me, we built our business, and I know you did, on 6, 7, 8, 9, 10% cash on cash all day long. Levered and great IRRs, and I just don't want to stretch that far. I don't want to overpay just to do a deal. And so on that deal in Dallas, it was a nice value add. Had everything that we wanted. It was what I call forced equity. So when you find something that nobody's really touched for 15, in this particular case, 16 years, the owner had owned the property and hadn't done a lot of interior work, you pretty much know that that's going to be a value add. So that's going to be somewhere between $100 and $300 a month. You have to figure that out. And a lot of it depends on how much you spend. But that's what I call forced equity. So we were willing to stretch a little bit more on that one because of the forced equity. And so we did, and we still got beat out. I think there were 25 or 30 offers. We made it to the best and final. There was a certain number that we went to, and off the top of my head, I just can't remember. I'd be guessing, but we went a 2 million higher than we wanted, and we were in the top 5. And then we added another million, and we made it to the top 3. And we just said, listen, now our returns are, even though it's a nice value add, our returns are to our investors aren't what we would want to do. And so we would get it. It's like a capital gain deal as opposed to a cash flow deal. And I like to have both. I like to pay my investors monthly or quarterly out of the cash flow, and these folks are trying to save on tax, or they're trying to place money from a fund, and so the money that they've got is driving the pricing, as opposed to the fundamentals back in the day when before all that.
And I think that's really probably a function of maybe how that ultimate buyer probably structured his deal. Maybe he went with a higher leverage bridge loan. You might have been underwriting like a Freddie Mac agency loan, and you operate really similar to me. Like your capital is very similar to the way I raise capital, which is in a syndicated high net worth pool versus having maybe a joint venture with one private equity firm, or maybe layering some mezz or preferred equity behind it to really try to juice that IRR to really stretch to make that deal make sense. Yeah, quite a bit.
That's exactly right. Yeah. A lot of it is how the money is. I'm a long-term hold guy, Michael. I love this business, but it's hard to find deals, and the last thing I want to do is find them for a private equity group, that makes me sell it 4 years later, so that they can make their hurdles, and then I just have to give all my money back to my investors. They have to pay capital gains, and then they say, if the market's going the right direction, it all works, but when it doesn't, and I've been in that position, that's kind of a when the rubber hits the road.
Yeah. So one of the things I always try to do, Ken, is leave an actual actionable tip with viewers of the show, listeners of the podcast. And you are probably one of the few people I think that do it even bigger or greater scale than I have, which specifically meaning syndicating capital. I mean, you have, I don't know how many thousands of investors. I'm getting ready to do my K1s right now. I think we're doing 1,500, 1,600 K1s, and I bet you're going to do more than what I'm about to do right now. What has led to your success? I know it wasn't overnight. I know it's been kind of a thing you've built over time. But what are one or two things that you've done that have actually been really successful in growing out and scaling out your investor database?
So, what happens with our investor database is that it's mostly been by referral. And, we've done an annual investor summit. That's been really popular. And we do here's what's going on behind the curtain summit. And we would have hundreds of investors fly in, and not all of them, of course, but then we would live stream it and record it for the ones that couldn't make it, because we have investors from all over the world. And inside of that, Michael, we would kind of give them some of the secret sauce. So we would say, this is what we're doing with, stuff that I'm sure you do, but one year we said, okay, we took a look at all our flooring costs as an example. And our flooring costs were, $6 or $7 million, or maybe more. And then we went and remeasured all our properties, all the units. We found 2 vendors to bid on the properties. And then we found ways to actually, put carpet in or flooring for less than we were doing. And we ended up cutting our flooring costs in half. So
Wow.
now that's obviously something that a lot of smart people in the business are doing, those kinds of things. But what we did is we brought the whole team that did that up on stage, and they walked through it. And essentially, we do that with all the stuff we do on the marketing side. We do that, all the stuff that we're doing on the social media side, all the stuff on how we're managing our individual rents at each individual property. So from an operational standpoint, we're showing them the things that we're doing from a value standpoint, with our renters insurance or our collections and all that stuff that we've now brought to in-house, and we've obviously juiced our returns that way. So that's been super successful. And then the investors, because a lot of times, as you know, we raise the money, we pay the money out, we send a letter, we get a phone call. But this is what the opportunity where they come, and Ross and I pay for the whole thing. So the investors come, we have 2 days together, we have dinners, we have cocktail hours, we have all that stuff, and we get a chance to know them really well. And then what happens is they refer to their friends and say, this is a company that, and then they get an opportunity to also walk through, things that did not go right. And they're all our regional vice presidents are there, all the accounting folks, and our whole team is there. And so they can actually sit right down with our regional vice president and say, what's going on with my property, my asset, and they can get face to face with them. So that's been one of the bigger things that we've done. That's built trust with our investors, and then of course develop lots of referrals.
Yeah, no, that's a great platform for your investors to get to know and like you, and then it's kind of like a little community. It can build a sense of community and camaraderie, and I'm sure that's been great for the referral base. As we kind of wrap the conversation up here today, Ken, you and I have been in the business a long time. You've been very fortunate and very successful along the way. If we're talking to maybe someone who's looking to break into the industry, maybe like your sons are just both in college now, and if they're looking to kind of get in the industry, is there any sort of advice you might give your son or some of your son's friends that are looking to kind of break into the multifamily industry?
So the timing is perfect on this, Michael, because my son literally over Christmas break, he's a senior at University of Arizona, interviewed with a group, and I've given this a lot of thought. And so I think that if I could have done one thing differently personally, I would have learned the finance part of the multifamily business. So, the price of equity, like you talked about earlier, the price of debt, and how the numbers really work. And, I kind of started on the ops side, the management side, and I did learn that because you have to. But I'm trying to get my sons to learn, I don't know about you, but I wasn't great at math as a kid, but I have to be. So I had to figure it out. And so I want both of them to understand it from that standpoint, because it's just math. At the end of the day, if somebody's going to give you $1 million, and they want a 10% return, you got to figure out how you generate $100,000 a year out of that. And so that's where all the magic is. That's where all the juice is. That's where the value add is. That's where the forced equity is. And if you can't see that, then you're not going to be able to sit down with an investor and ask them to invest, because if you don't know those numbers, if you're just saying, hey, all the properties in the area went up last year, and so they're going to go up again, which is what a lot of people do. So for me, I've been trying to get my kids on the into that world, so that they understand when they hit the road, and they get into this business, they're looking at it from a very practical business financial standpoint. And it's just math. And that's how I look at deals now, as you probably do too. There's a lot of hype, and I always tell people the bigger the brochure, the worse the deal. I mean, as you know, a deal when I got that value add deal in Dallas, there was only one thing. It was like owners had it for 16 years. It's never been upgraded, and there's about $200 to $250 a unit in value add. I already knew it was a $7 or $8 million value add before I even looked at anything, and then you kind of back into it. So once you kind of look at things that way, then you can make really, really good decisions, I think.
Yeah. So Ken, kind of as we wrap up here, what's got you excited in 2021 today? And I know you are launching more web shows. You've got a podcast. Maybe how do people find out a little bit more information about you?
Sure. Well, we have obviously you can go to MC Companies, which is our primary company. You can kind of see our deals and that kind of stuff. And then I also have done, as you know, Michael, on kenmcelroy.com, we put together a landing page for your listeners, that investing show, and they can get tips on how to prepare for the 2021 real estate, situation. And those are probably the two best ways, at kenmcelroy.com and at MC Companies. And of course, we've got the YouTube stuff. We've got a bunch of social media, and we're committed to education, because I think there's enough for everybody to go around. We do, we have our own in-house management company, our in-house construction company. And so we get lots of questions at this point. I think when last I checked, we had around 175,000 subscribers on YouTube. So we get a lot of people asking a lot of questions. And so we get into that. And I'm trying to do education for those people, and for the people on Facebook and Instagram and LinkedIn, and they're asking really good questions, just like you and I did when we were first starting in the business. And so I'm provide.
Yeah, perfect. Well, Ken, it's been too long since I've seen you. As we were starting to record this, I realized last time I saw you was in the most random place ever. It was Amalfi, Italy. Both on vacation last summer. Just kind of ran into Ken eating lunch.
I know.
So
that was a nice surprise. I'm walking down Amalfi. It's not a very big place, and all of a sudden I hear, "Hey, Ken!" I look over, and there you were. So
we should have both done a peak cycle if we saw each other at an exotic place like that. But definitely appreciate your time. Definitely encourage anyone that wants to learn a little bit more about the space, a little bit more about multifamily. Go check Ken out. There's various resources. We'll make sure we put a link to all that in the show notes and on the screen below here as we record. So Ken, appreciate it. We'll see you guys next week.
Follow the Multifamily Investing Show on Facebook, YouTube, LinkedIn, and your other favorite podcast platforms. To learn more information about investing with Michael, please go to www.multifamilyinvestingshow.com.